Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have George Schultze, founder of Schultze Asset Management. It's great to see you again. Welcome back to Trade Talks.
Thanks for having me, Jill. Happy to be here.
And tomorrow is the big day. We know ADP missed numbers. Everyone's looking at jobless claims, and we'll get our second look at Q2 GDP. What are your thoughts there?
So we're currently running at about 6.6%. Looks pretty stable. I mean, it might come down a little bit year-over-year growth with the continuing recovery from COVID, but we may have a little bit of a setback also with the Delta variant. So we'll see how it all plays out.
And as we think about interest rates and inflation, I mean, the market's always worried about something, but these particular areas really seem to be the most impactful. And I guess the question is, how can inflation be transitory? So for example, if you are paying someone to come in and fill these jobs that small businesses desperately need to fill, and you pay them very well, that's not transitory. You're not going to decrease their wages once we get back to whatever normal is.
I think that's right. I mean, right now, CPI is at about 5.4%. The Fed is holding, the pedal to the metal, as it were, with a Fed funds rate, interest rate at between 0 to 0.25%. I think that's right, though. Not necessarily transitory on inflation. And I think, let's face it, all the viewers of this show are seeing inflation in their lives. Pretty much in every single part of the market, everything you buy is going up in price, whether it's cars, whether it's tuition, whether it's milk at the store. Prices are going up, and I think that's where the Fed is really in a bind because rates are so low. They're as low as they've been in the history of mankind. How do they slowly start to taper without causing, a complete panic and taper tantrum like we saw last time the Fed was looking to taper?
Well, if we look at the other side of it, when we talk about distressed assets, default rates have actually plummeted year to date. Why do you think that is?
Well, it's clearly because of all this monetary and fiscal accommodation. The Fed, the U.S. government has never spent so much money before, and the Fed has never been so aggressive in terms of monetary accommodation. So whether it's extremely low interest rates or monthly QE purchases, the current run rate is about 120 billion per month in terms of mortgage-backed securities and treasuries. So how does the Fed, sort of reverse some of that trend? And the question is, we don't know. But for now, there's been just an unbelievable recovery in the economy. It's great. We came out of a pretty dark place with COVID. But as a result, defaults, have now dropped well below their long-term average. And so, there's not that much distress out there. But I would say there are a lot of think of them as zombie companies that are over-levered that really should restructure and reorganize. And there's a lot of leverage. I would say more leverage, overall than there was prior to COVID. And so, how you unwind all this will be interesting to see.
Right, and I agree with you there because at the end of the day, tapering is not tightening. There's a big distinction there. And if the economy is doing as well as it has in this recovery that we've seen since the March 2020 lows, I don't think anyone expected. The Fed has been very clear about telegraphing their message. So if in fact everything's so strong and the markets are doing well, why would a taper cause a tantrum? You would think that tapering is a sign that the economy is strong enough to manage itself.
I think that's right, but I think it is sort of a fragile equilibrium, as it were. So what we're doing here at Schultze Asset Management is we're advising clients to hedge their portfolios. There are some great long value investments to be found right now, especially in the post-distress equity realm. But with any portfolio, you should look to hedge the risk of a market sell-off and also the continuing risk of inflation. So that's how we're advising our clients to protect their portfolios in case there is a sell-off or in case this inflation trend continues. On the value equity side, though, with post-distress equities, there are some incredibly interesting companies like Chesapeake Energy. The ticker there is CHK. That's an independent exploration and production company with oil and gas assets across the United States. They're benefiting from the inflation trend with the commodities that they produce. They restructured and emerged from reorganization back in February of this year after eliminating about $8 billion in debt. And they're just incredibly cheap right now. You're seeing an interesting catalyst with Chesapeake Energy as well. They're in the process of closing the acquisition of Vine Energy. another E&P company focused on the gas assets as well. Combined, there'll be some synergies with that business, and we expect a big return of capital to shareholders going forward from that. Another potential value investment idea is a company called Alpha Metallurgical. This is a metallurgical coal miner. So they make coal, but it's used to make steel, or they mine coal, it's used to make steel, not to be burned and cause trouble in the environment, but rather to make steel, which is used for infrastructure. And Alpha Met is benefiting because you have a pretty high likelihood that this infrastructure bill will go through. Alpha Met came out of bankruptcy. When it emerged from bankruptcy and reorganization, it also eliminated about $8 billion in debt, and also, like Chesapeake, extremely cheap. So we're finding some really interesting post-distress equity companies like that that are exceedingly cheap. And on top of it, they have some interesting events, whether it's M&A, special dividends, stock buybacks, things like that, that at this point in the cycle can really provide event-driven returns to investors and potentially be somewhat insulated from the overall market trends. Having said that, I'll go back to my earlier point, which is, every portfolio should be hedged for risk of market loss as well as for inflation.
All right, George, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.